So many times we take trades and then we feel the market owes us. We feel we have an emotional attachment to the market, and vice versa with the market as well. So many times we take trades and then we feel if I bought this currency pair at 1, it means that even if it reverses and it goes all the way down to 0.5, it will come back to 1 for me to close. So many times we feel the market owes us, or the market has an emotional attachment, or the market remembers the price at which we bought. One thing I want you to understand today is that the market actually has no emotional attachment. The market owes you nothing. The market literally has no relationship with you. Whatever instrument you are trading, it has no emotional attachment to you. Let's take gold for example. Gold might be your favorite currency pair, but you are not gold's favorite trader. You feel you have an emotional attachment to gold because you've made money on gold, because you feel you understand gold, you've traded gold for so long. But gold does not reciprocate a relationship with you. All gold is doing is moving whatever direction it wants to go. So many times you might take a trade on gold. Let's say you buy at 1800 and then you feel because you bought at 1800, if it reverses and goes all the way down and you're in drawdown and it's going against you, it will come back to 1800 for you to close your trade. So many times you realize that you end up blowing your account, or it ends up going all the way against you, and because you failed to hit your risk management, or you failed to get out of the trade when it gave you the opportunity to. I'm sure you will agree with me that so many times you lose money when the market actually gave you an opportunity to get out. So many times the market gives us an opportunity to exit our trading positions. We fail to take advantage of those opportunities. We fail to accept those particular opportunities. We fail to take the chance. Then we end up losing more than we're willing to actually lose on that particular trade. One thing I always tell my mentees is that a bad trade is a bad trade. There's no doubt about it. A bad trade is a bad trade. There's nothing you can do about a bad trade other than to exit that particular bad trade. What is a bad trade? Someone might call a bad trade a losing trade. A losing trade doesn't necessarily have to be a bad trade. A bad trade basically means that you took the trade without following your basic entry criteria. It means probably there was no confirmation, there was no confluence, there was literally nothing which justified the buy or sell you took. Let's say I normally like trading gold, and then I use, let's say, demand and supply to take trades on. That's the only strategy I use. And then today I wake up, open the market, and I realize I just felt gold is buying, so let me also buy, without heeding my demand and supply tactic. That is a bad trade, because now I'm not actually trading with my principles. I'm not following any of the rules I've set for myself. I'm not following any of the principles, any of the things I've learned. I'm not using any of my trading tools, any of my analytical tools to take that particular trade. That is what makes it a bad trade, because now you are basically using emotions, makes you basically jumping on trades when there's no confirmation. What I always say, jumping in front of a moving train or joining the party when it's too late. Most of the time, what makes us take bad trades is FOMO. Fear of missing out. Fear of missing out basically makes you jump in too early because you want to make money before everybody else, or it makes you also jump in too late because you don't want to miss out on a trading opportunity. So today I'm going to use a few scenarios to explain how I will get out of a bad trade. So today's video is titled How to Get Out of a Bad Trade. Before we start, please again, I need you to like this video. I also need you to subscribe to this channel, smash that notification bell so you get notified anytime I go live or drop a video on YouTube. We'll be right back. One thing which I normally say to a lot of beginners is that the first instance on how to get out of a bad trade is getting out of the bad trade. You are new to trading, you are taking this trade, you are in losses, you cannot handle the losses going against you, but you feel it's going to reverse. You are basically hanging on to hope. You are struggling with your psychology, you can't concentrate, you can't eat, you can't even talk, you can't do anything. What I want you to do is just exit the trade, because a bad trade is a bad trade. No need to keep hanging on to hope and then lose all your money. Just exit the trade. That's one instance. So if you're new to trading, the trade is not going in your favor, you took the trade on yourself based on no principle, no trading entry criteria, and it's going against you, just exit the trade. Sometimes as beginners, you might scalp, you get some beginner's luck and it goes in your favor, fine. But in so many instances, you end up losing your money or blowing your account, so just exit. The second instance I want you to also look at is also stick to your stop loss rule. One thing I always say about stop loss is the reason why you set that stop loss is because that is the price you want to actually be taking out of the trading position if it's not going in your favor. If you decided to raise, let's say in terms of money, $50, $20, $100, $1,000, stick to it. If you do not want to go through any psychological stress, just stick to your stop loss and then wait. If the trade hits your stop loss, you are taking out. If it doesn't hit your stop loss and it reverses, comes back to entry or goes into profit, you can close with little profit. You can choose to hold your trade, but just stick to your stop loss rule. The third one, which is the most important one we are doing here today, is what we call hedge. It's a concept we call hedging. Hedging is actually a very misunderstood concept in Forex. It is super flexible. What it actually does is that it even prevents you from using stop losses, because what it does is it actually balances out or averages your losses. So you can wait for a win and then pair it up with small losses. So let's say if you took a sell and it's going against you, and you are losing, let's say $50. Normally, if you are hedging, it means that you actually now take a buy, gives you more profit to the buy, because you basically took the sell and you realize that it's going up. So if you are hedging, it means that now you take a buy, make more profits, then you pay it up with the loss, then you take the loss it gave you, then you close the buy. Pairing up huge profits with small losses now balances out your trading. When you're hedging, what it simply means is that you are reducing risk by taking a trade in the opposite direction. That is what we simply mean by hedging. Reducing risk by taking a trade in the opposite direction. You've sold, it's going against you, it's buying. You now take a buy to help you average out the losses. So now you take a buy, you make some profits on the buy, then you close both positions, then you just exit the trade. One thing about hedging is now you want to exit your trades very early. You don't want to come back and hold trades again. So you're basically doing that because you want to exit your trades. But there's one thing I always see when it comes to hedging is that you need to look at the structure. You also need to look at the candlestick. If you're in my community or my VIB, you realize that there are instances where I send out signals. After a while, I come back and tell you to exit the trade, we re-enter later. And then 99% or even 100% of the time, that decision was always correct. I know what I saw, which was a clear indication that the market was now about to go in the opposite direction. And then hedging, I can't do hedging with the whole community. Hedging is normally an individual trading decision. So normally, I might be hedging on my own, but I then know that there are so many people who might not be able to handle that particular hedge. So I think last week, I gave a trade on GBP CHF. It just kept consolidating. It was going to go in the opposite direction. So what did I do? I just told the whole community to just exit. I think yesterday as well, it was on NZD USD and then NZD CAD, which you can see on your screens. I gave buys on both positions. One was with Fibonacci, the other was with a breakout, and I realized that the breakout was going to end up being a false breakout, and then the Fibonacci was also going to retrace back down again. So I realized and then saw how the market was doing. I looked at the structure and I told all of them to actually exit. So you realize that trade management is key. The fact that you've taken your trade, your buy or your sell after a confirmation doesn't mean that is it. You also need to come back and keep monitoring the market and then see whatever new developments might be coming up. So without wasting my time, let's jump right onto the charts and let me show you a few examples where I use hedging to get out of losing positions. Okay, so if you look on your screens, the first instance I want us to look at is on gold. Yesterday I actually took a sell on gold because I expected it to be a breakout. So let's go back. Let me show you exactly when I took this trade. You can see the trade history on your screens. So it was very early in the morning around this particular level, but this candle was actually a bearish candle, so I felt it was going to be my favorite continuation pattern, like I've always told you guys. Okay, so now if you look at the screens here, the next candle was actually a small bearish candle. Then the next candle which came after that was actually going down. So it was a bearish candle. It was later that it closed up. So you realize that it was a bearish candle all the way down, a full bearish candle going all the way down. So I actually felt that the market was going to continue to sell for a bearish continuation. You see consolidation, and then the last candle is normally bearish, so it normally indicates that the market is about to go down. So in this instance, I actually expected the market to actually sell in this instance, and it was also on the third touch. On the third touch of the trend line, I expected it to be a breakout based on how the candlesticks looked at that particular point. But the mistake I made, remember what I always say about bad trades, you jumped in without waiting for your confirmation. That was what made it a bad trade. So in this instance, I actually failed to wait for the market to give me a closure here before taking this trade. So that was what made it a bad trade, because if I had waited for the candle to close, I would have realized that it was actually respecting the trend line in this instance. But I took the trade when the candle hadn't closed yet, so he had filled all the way down here to the bottom. I was expecting to take a sell here. The stop was right on top of the range. Then now I expect it to at least come down to this level. Then I actually exit when I make my profits. The reverse, I started going into deep losses. So it was about almost 35 to 40 pips drawdown. So once I saw the candle close there, I realized that no, the sell was invalid. So what I did was I actually hedged by taking a trade in the opposite direction. So as you can see on your screens, you realize that I actually now ended up taking a buy in the opposite direction. Now I took a buy here, went to about 40 pips profits, then I just closed the buy instantly. One thing about hedging is that the moment the previous ones come back to entry or the losses reduce, that balances out your trades or gives you positive figures, just close it. That's what I always do. So the next candle actually brought it back down. So once it brought it back down, I actually exited the trades. Then I was done because I felt the market was probably going to respect the third touch of the trend line. So I just exited the trades there and then. I decided not to stick to it anymore because I realized that what I did earlier was a bad trade. So even though I took my trades without waiting for confirmation on this particular setup, I still had my hedging technique which allowed me to get out of the trade. If I wasn't that experienced, I would have held on to hope and then blown my account when I clearly saw it was a third touch of my trend line over here as well. Before we continue this video, I want to talk to you guys about Fastbull, which is a leading platform for fundamental analysis. If you are a forex trader, you can literally go to Fastbull for all your trading news, for all your economic data, for basically your economic calendar with respect to whatever pair you trade. It means that if you want to trade NFP, if you want to trade CPI, if you want to trade FOMC, if you want to trade anything at all, any fundamental data as well, or any website that allows you to get your news, you can just use Fastbull for that. And I have some good news for you. Fastbull is actually now available on your app store, so you can actually use it on your phone. I'll pin the download link to the comments, so just click on that and then download Fastbull onto your mobile devices. So you realize that if you look on your screens on Fastbull, you can clearly see we have our economic calendar. You also have AI signals on the side. Remember what I said about AI signals? If there are AI signals, basically means that they have AIs which actually make analysis and then tell you what the market is going to go. You also have trade ideas or trade recommendations from leading analysts on the market, which you can also see on your screens. Remember, I also told you that there are also videos, literally videos on fundamental analysis you can also get on Fastbull. So you can literally set it up to your taste to make it look how exactly you want it to look and then how you want to take advantage of it. There's whatever economic news you want, whatever country you want to focus on. If you want to focus on high impact news, all of it is available on Fastbull. So on your PC, just hit the link in my description to go to the website, sign up, and then start using Fastbull. If you also want to use it on your phone, download link pinned to my comments, click on that, go to Fastbull, download it onto your mobile devices, and then keep up with all the fundamental data that are available to you as a trader. So with hedging, you realize that you're in a sell, you are going into losses. You realize, no, it's going to be a breakout, it's going to go in the opposite direction. What do? You now buy. So let's say if I use 0.5 for my sell, I can use 1 lot for my buy. That way it's twice as fast and it makes me more. That way I'm able to close my losses early and then take the profits, exit both trades, and have my psychology intact, and then just relax and then find a much more solid trade. So what I always say about bad trades is that for a bad trade, you normally fail to heed your rules, you normally fail to practice proper risk management, you normally fail to wait for your confirmation. You just take the trade because you're expecting the market to keep going and the trend is going without any confirmation because of FOMO, which is fear of missing out on that particular trading setup. So we are finally at the end of today's video. Thank you for joining me. I hope it was extremely educative, insightful, informative. If you want me to make more content like this, I need you to smash that like button. I also need you to subscribe to this channel. Join us on YouTube, subscribe to this channel. We want to approach 10K subscribers in the first quarter of this year. So subscribe to this channel. Also hit that notification bell so you get notified anytime I go live or drop a video on YouTube. You also want to keep up with me on my socials: KOMMONFOREX on Instagram, KOMMONFOREX on TikTok, KOMMONFOREX on Telegram, KOMMONFOREX on Twitter as well. Also hit the link in my description to also join my trading community on Telegram, the KOMMONFOREX trading community. Sign up with my recommended broker with the best trading conditions, 24-hour customer service, and then the tightest spreads. You want to trade with excellence if you have your own funds and then you are looking for a reliable and then trusted broker. Thank you for joining me in this one. See you in the next one. Peace.